Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management.
Welcome back to Happy Half Hour with Toby and Nick. Today is Wednesday, May 22nd. We hope you all are having a good spring. We've got our usual dance today. I've got some questions. There's some really hot topics that I want to get to. One study or one survey that just came in today, polling how Americans feel about the economy, really caught my attention, and I think it's the sign of a bigger issue. So this just came across the tape like 30 minutes ago. So U.S. stocks are up about 10, 11% as of this recording for the year. 50% of Americans that were polled, and I don't know the details of the sample size or anything, but 50% of Americans that were in this survey think that stocks are down, and like 56% think the economy is in a recession. And I have a couple theories on why I think this is so egregiously wrong, but I wanted to get your feedback and input first.
Yeah, I guess I'm not totally surprised by that. Maybe the numbers are a little higher than I would have expected, but you know, I'm one of the few people that still takes a newspaper every day and reads a newspaper every day. And you literally can't go through a newspaper without terrible story, bad story, terrible story. So, you know, I know you've talked about this before. We're constantly inundated with negative news because negative news tends to sell in the old days newspapers. Now it sells online subscriptions. So we just get inundated with it. And I think that has a tendency to get people thinking things are worse than they are. That would be one thought. And then the other thought I would have is I think that the economic experiences that we're all having differ from person to person, geography to geography, class to class. And so it's possible that people out there that have a fixed income and have seen inflation grow by 20% over the last several years, it's possible those people do feel like we're in a recession because they can't make ends meet when they used to be able to do so. So those would be some of my thoughts on it.
Yeah, and Toby didn't know that I was going to ask that question, and I think you've hit two of my three boxes. And I have wrote about this a lot, where I think some entity did a study about the types of stories that media produces now, and like 85% of them are designed to make you feel worse. So I think that's the first thing. And many people get sucked into the vortex of mainstream media, which really is a misalignment of incentives. Rather than give you objective news, their job is engagement. Well, it so happens that train wrecks and controversy and scandals sell. You know, if I get on the news and say, hey, everything's going to be okay, market's going to melt up over the next 30 years, no one's going to invite me back because I sound aloof and stupid, right? But if I lean in and tell you, hey, the U.S. dollar is going to collapse and the banking system's going to blow up and the U.S. debt is going to default, like I'm suddenly a smart and sophisticated person. So I think that's the first thing. The second thing, which kind of piggybacks off the first thing, is I think there's a lack of the ability to independently think in this country. Like people just swallow the fire hose of information that is thrown at them, whether it's politics or social media or what the media is saying. People just believe everything. And if you actually pause and take a step back and unplug from your device and independently think, I think we would all be better off. Okay, so that's the second thing, lack of independent thought. The third thing, and I think this is probably the biggest culprit, is people today look at everything through a political lens. Like if a Democrat is sitting in office, automatically half the country, the Republican half, is going to think things are terrible. And if a Republican is in office, the Democrats think everything is terrible. So when you look at everything through a political lens, half the people in this country are going to think things are terrible. And I think it's not ironic that the numbers are pretty close to 50%. People that think we're in a recession, people think that the market is down, which is wildly wrong. So it's probably a combination of all those things, but it's certainly perception and what is actually happening. That's a pretty big gap based on this study.
Do you think that the mainstream media is reporting the news the same today as it was 5 to 10 years ago? I mean, do you think there's been a shift in how they report things, or do you think the shift has been external social media? So the people receiving the news, their lens is different, and therefore they perceive the news differently than they might have 5 to 10 years ago. It just seems like there's the term I've heard, and I think it makes sense, is gaslighting. There's a lot of, hey, let me tell you a fact, and then let me tell you why that fact happened. And then if you really drill into it, even the fact that they shared is not accurate, or it's accurate, but it's misleading.
Right.
And I'm wondering, curious as to you, whether you think that's a recent phenomenon or that was always the case, but now we're more inclined to believe it.
I think it's always been the case, but I also think the volume has been turned up the last 10 years or so. And, again, when you look at how these incentive systems are placed, whether you're an influencer on social media or a legacy media company, let's start with the legacy media side. They're compensated to sell ads, to get eyeballs, to get engagement. The more outlandish the claims are, the more outlandish the guests are, the more ridiculous the headlines are, the more ads they can sell for a higher price. Okay. And then on the social media side, I mean, if you give everybody a microphone, people are going to say some outlandish stuff. And it's the same phenomenon. Like some guy on Twitter that I follow, he's a really sharp investor. He's called a lot of the last couple of years loosely right. And he's shared some frustration that he couldn't get any subscribers on his YouTube channel. Like he's really struggling to get traction. But he shared another YouTube channel that's been predicting the economy collapsing for the last decade. And the Doomsday channel has like 100x the subs that the Smart Investors channel has. And that just goes to show you people gravitate towards the dumpster fire.
That's good. Okay, I'm going to switch a gear here and talk a little bit about the recent addition to our team, temporary addition to our team. Talk about our intern that's going to be joining us this summer and what that's going to do for the firm and hopefully do for the intern.
So I'm supposed to talk about Brooke?
Yes.
Okay. So we've had interns in the past. I think Brooke Baxter, who's our newest intern, she is a sophomore at Pacific University here in Forest Grove. So this is our third intern, but we didn't set out to have an intern this summer. It just kind of happened. So I'm quite active on social media, and I shouldn't say social media, Twitter, LinkedIn, and Facebook, those three platforms. I share my blog, our podcast, and all the Pierce content on those platforms. Through that, my personal network has grown, Pure Portfolios page has grown, and Brooke found us online, and she sent me a handwritten note outlining her goal of an internship, shared a bit about her background. That got lost in the shuffle. She called Pure and spoke to one of our associates, and just her whole approach. No one sends notes anymore. No one writes handwritten notes. So that stuck out to me. And upon my first visit with Brooke, it was apparent that this person was different. She was full of energy. She was proactive. She was very curious. She'd read a lot of our content that was online. She got our story. I could tell that she did her homework, and I immediately wanted to hire her. Of course, we went through the process, but I'm all about paying it forward. I'm all about people that want to get ahead and start and lean into action. And Brooke is certainly that. And I joked during our team meeting when we introduced Brooke yesterday that she's just light years ahead of where I was or any 19-year-old was at the time of being a sophomore in college. So she's just an impressive person, and I can't wait to see where her journey takes her. There's no doubt in my mind that she's going to be a stud advisor someday, but she's just embarking on her journey, and we're happy she's a part of our program.
Yeah, it's been great to meet Brooke, and I look forward to seeing what she's going to be able to accomplish this summer. So usually on these podcasts, we pick a asset class and have you comment on it and give your current thinking on it. Today, we'll do a kind of a hybrid of international, developed, and emerging markets. If you look back historically, they've underperformed over the last 10 to 15 years. And so you know, from time to time, I'll get feedback that, maybe we should put more in U.S. stocks, more in large cap U.S. stocks. In other words, let's continue to invest in what's working. How do you look at the diversification that international and emerging market stocks provide? And why is it important for those to be in Pure portfolios?
So there's a few things there, and I'll talk about emerging and international together, even though they're different. But there's no doubt about it that the last call it 12 to 15 years, it's been U.S. large cap stocks and everything else. And it hasn't even been close. So I believe this is one of the most egregious gaps between outperformance in U.S. large caps and emerging markets in foreign stocks. And at some point, and many people have been wrong on this, I certainly thought it would happen sooner than later, and it still hasn't happened yet when you look at performance. I mean, it's getting closer this year, and certainly emerging markets especially are behaving better because China's had a ravenous rally. But that gap has defied every cycle over the past, call it 120 years. And investing very much does work in cycles. So what's worked, U.S. large caps over the next cycle usually doesn't work as well. And there's a few dynamics here. One, as you touched on, is the recency bias. So most people want to own more of what just worked. Well, what just worked is U.S. large caps. So I've had questions like, hey, why in the hell do I own international stocks or emerging markets when U.S. large caps are the place to be? Okay. If you go back to the year 2010, the last 10 years before that, so 2000 to 2010, nobody wanted to own 100% of the S&P 500 because it was flat for 10 years, like literally flat, 0% return, okay? During that same stretch from 2000 to 2000, emerging markets were up like 950%, all right? So nobody knows what happens next. That's why for a person that's retired or about to retire, looking to manage risk, looking to invest in a asset class that's beaten down or out of favor, I don't think you can ignore emerging markets and foreign stocks. So they should be part of a diversified portfolio. And part of diversification, and I wrote about this a few months back, is something is not going to be working. Like if you own 8 asset classes and they're all moving together, that's really not a diversified portfolio. Okay. But if you own 8 asset classes and some are up and some are down during each part of the cycle, that's a true diversified portfolio. So that's just the cost of owning multiple asset classes. And it just so happens emerging markets and foreign stocks have been out of favor. There is evidence to suggest that that's starting to change. Yeah, I mentioned China, which has been out of favor for a long time as well, starting to behave a bit better. Does China have issues? Yes. But at some point, some of these assets are just so attractive where the worst case scenario is not that bad, and you have a pretty nice run rate, a pretty nice narrative on the upside.
Yeah, and the only thing I would add to that is it's yet another reminder that valuation is a terrible timing tool because international stocks have been roughly half as expensive as U.S. stocks, but they've been that way for the past 5, 6, 7 years. So the argument that I want to own international stocks because they're cheaper is a valid argument, but there's no guarantee that that gap will close within any specific period of time.
Yes.
Great. Over to you.
Okay. Do you have any personal investment thesis or mantras that you adhere to? Like Buffett says, I don't buy anything that I don't understand. Graham said, I require a margin of safety. It's not making the most out of buying a stock. It's stocks that I can't lose money on, or the chances of me losing money on are small. Like, do you have any personal investment theses that you adhere to?
Yeah, I guess I know you weren't asking me to pick one of those, but I would say I'm more inclined to follow the Buffett model, which is, you know, AI stocks have done unbelievably well over the past, 6 to 12 to 18 months. And I own NVIDIA and a couple other ones in my portfolio, but I'd be lying if I said I fully understand the long-term ramifications and implications of AI and that I know which companies are going to be the winners and losers. So I try to buy things that I understand, buy things that I can get my head around, and I tend to use ETFs. So, for example, if I want to invest in artificial intelligence, I'm not going to go try to pick 2 or 3 winners. I'm probably going to buy an ETF that has 30, 40, 50, 100 different companies, some of which will be winners and some of which will not be winners. But that way, I at least ensure that I have a better opportunity to have the winners in the portfolio. So just buying things that I know, buying things that I understand, and then using ETFs where I can to kind of spread that risk versus buying a single stock. So how about you? Anything that's top of mind for you that you look at when you're doing your own personal investing?
So I'm a fan of simple beats complex. So that's one of my mantras. And also I err on the side of doing nothing. Like I can't even remember the last time I sold anything. And I use ETFs as well. And a lot of my friends ask me what I'm doing with my personal assets. And they're shocked when I say nothing. Like I don't have any interest. I don't pay attention. I save. I focus on my savings rate. I don't sell anything, and I keep it simple. And a lot of them are baffled, and they look at me almost like I'm an idiot. But like the way I equate it is like back when I was in college, I worked at a golf course. Like I was on the greens crew. So I got up at 3:30 a.m. I called it the man shift. And I think this was my junior year. So I did this for 3.5 months straight. I'd get up at 3:30. I'd mow greens. I'd be half asleep. Oftentimes, if I went out the night before, I didn't go to sleep. The last thing that I wanted to do was to play golf at that course after getting off my shift. And there's a little bit of that at Pure where this is all I do. I mean, we manage 330 million. I'm in charge of a good chunk of that. And all I do is talk markets, invest, write about markets. The last thing that I want to do is toil over my personal assets. So hence, simple beats complex, err on the side of doing nothing, pretty much never sell anything.
Yeah, it's interesting when you're, at a dinner party or out with friends or something, and maybe somebody doesn't know what you do for a living. And then they say, oh, what do you do? Oh, I'm a financial advisor. And the next question often is, oh, well, what stocks do you like? Or what stocks are you buying? Or kind of the old broker mentality from back in the day that, well, if you're working in the stock market, then you must have opinions on individual stocks. And not that you and I don't dabble in certain things that if we find interesting, but we just don't spend the majority of our time doing analysis on individual companies because that isn't the approach that we think makes the most sense long term.
Well, what's funny is we both have our CFA, which is basically 90% of valuing stuff, mainly companies. So it's not like we can't do it, but it's certainly, as we zoom out and look at empirical evidence and what works and what doesn't work, I think having exposure to broad asset classes, having a framework to manage risk, stripping emotion out of the investment process, managing drawdowns, all of those things are much more important in our opinion.
Okay, next question. We always do or try to do a kind of investor corner. I'll take a specific investor, lay out the scenario, and then you can talk about what are the things they should be thinking about, considering as they move forward with their life and their investment portfolio. So today we're going to talk about the winners, the people that have made it. They've retired perhaps. They've got plenty of money to do everything they want and then some. And they worked hard over their career to get to this point, but let's pick a number, $5 million in assets to support them in retirement. And it would take a miracle for them to run out of money moving forward. What advice would you have for those folks?
Avoiding stupidity is better than seeking brilliance. So I would shun pretty much everything around me. I wouldn't watch the news. I would focus on my kids, my grandkids, my passion hobbies. I would take care of my body. I'd work out. I would travel. I would focus on everything else but money. Like the whole point of working and grinding and saving and investing is to not worry about money. So I would take that money, convert it into experiences or things that I'm passionate about and live my life.
And what would you say to folks that were successful at making the money, building the money throughout their life? And then I sometimes bump into people that say, oh, I've got an investment opportunity in car washes or in laundromats or in something that is completely from their area of expertise. But it's like, I have the money. I want to keep it working for me. So I'm going to go invest in one of these opportunities that I bump into and make myself more money.
Avoiding stupidity is better than seeking brilliance. So I would not even entertain any opportunity, especially outside of my sphere of expertise, unless it was an absolute home run, no-brainer, which if someone is bringing you an opportunity that's a home run, absolutely a no-brainer, I would probably ask, well, why in the hell are you bringing it to me? And right? Like you could do it yourself. So I would view everything with a lens of skepticism. And again, back to what I said, I would focus on everything else but money. Why increase your risk of ruin? Why complicate your life? You've won the game of capitalism. You've made it. Simple beats complex.
I like it. Over to you.
Okay, this is my last question, which is good because we're rounding third base about 24 minutes. So in your opinion, in general, what is the worst trait an investor could have?
The worst trait an investor could have.
Okay. And I'll give you a little hint because I used to think
Okay.
I used to think it was FOMO, the fear of missing out, like performance chasing, but I have a new one.
Okay. I would say the worst trait is tying their emotions into their portfolio. And what do I mean by that? Following it on a daily basis, getting excited when the portfolio goes up in value, getting frustrated, upset, despondent when the portfolio goes down in value, like having your emotions tied to how your portfolio is doing on a daily, weekly, monthly basis. I've heard you say before that if we are doing our job, the portfolio investment that we do should be almost boring and it shouldn't be exciting to watch and follow on a daily basis. And I think that's probably the worst trait. And I love nothing more than when I talk to a client and I'll go over their portfolio and they'll say, hey, I haven't even looked at this in 3 months, 6 months, a year. And I'll say, oh, okay, nope, I've been busy with other things. I know you're managing it. I trust you. So I don't need to monitor and watch it on a daily basis. And I frankly don't wish to. And that's music to my ears. So that would be the one I would say.
Yeah, and you hit it on the head. Good investing should be boring. Like for folks that want an exciting CNBC hot money type of approach, I think you can carve out a small percentage and do your trading and express your active views. But for your core wealth piece, it should be like watching paint dry. And I think someone said, like a famous investor said, if you want excitement in investing, take $1,000 and go to Vegas. And I think that's a really good way to put it.
Okay, last question I have for you. And it's the ultimate softball. What summer trips or summer plans do you have with the family this year? And what are you looking forward to this summer as we get closer to that, with school going to be out here in a few weeks?
Yeah, so we just actually booked a trip over the 4th of July to Sun River. So we try to go there once a year. We're trying to get to Lake Tahoe in August. And I think we're going to drive to Tahoe. It's not that far of a drive. It's like 8.5, 9 hours. So that'll be cool. So we always try to squeeze in, I'd say 2 to 3 trips with the kids. My kids are getting older. My oldest is 10, and it's coming where she's not going to want to talk to me. It's coming where being seen with dad is embarrassing. And I'm already starting to embarrass her. So, I feel like these next couple summers are going to be big, just spending time with my kids and focusing on some of these years that we'll never get back. Like it's starting to hit me that that's coming, and it hasn't hit me before, but just seeing her interact with her buddies, she's starting to wear makeup and she's got an iPad and she can text, and it's like, oh my gosh, this is coming faster than I know. In 2 years, she'll be in middle school. So that starts in 6th grade. She's starting to pay attention to boys. One of her friends told me that she has a crush, and that just almost brought me to my knees. So holy hell, the kids grow up fast. And I'm really looking forward to slowing down and spending time with the family and checking out for a bit. Same question for you.
Yeah, before I'll add one thing to your comment. The best trip that we ever did was we couldn't figure out where we wanted to go one summer. And so the kids put together a road trip itinerary. And we ended up going south in Oregon, then down to San Francisco and over to Yosemite. And we had 3 or 4 stops along the way. And to this day, that's still the trip that they remember the most and they talk about the most, not necessarily because of the destinations, but just the fact that it was a road trip. We were all together and kind of sorting through it on the road. Still probably one of the best trips and one that they talk about all the time. So
that's a good idea. I might have to steal that from you.
In terms of our summer, we've been really busy, so we don't have much on the calendar yet, but we'll definitely put something together to go to the lake for a week or go to Central Oregon for a week and get out of town and catch our breath and spend some time with the family. So definitely looking forward to that.
That sounds good. So this concludes Happy Half Hour, May 22nd, 2024. If you have any questions, feedback, or insults, shoot Toby a note at insight@pureportfolios.com. We'll see you next month.
Cheers.